Okay, good morning, everybody. I'm sorry I'm so late, and thank you, Steve, and thank you to Market Force and to you for your forbearance in putting up with the delay in my presentation this morning. It was as a result of the battery on my plane from Edinburgh having to be replaced, which sounded sufficiently serious that I didn't put up much of a fight. But anyway, I've been asked to talk about assessing distribution strategies post-RDR, and obviously you'll have covered some of this ground already. I came in during the panel discussion, and that was a very, very interesting discussion. I didn't agree with all of it, so it would have been nice to have been part of the discussion. But it just, I suppose, gives you a glimpse of the amount of change that we're going through in the industry at the moment, and the extent to which that is, I suppose, on the minds of probably everybody in this room, but all of the distributors across the UK in figuring out, as we come towards the end of the year, how things are going to change in the very short term, but possibly more interesting, and what I'll focus on today is how things are likely to change over the next few years. So when you're given the task of presenting something like this, you can go down a very sort of safe route and just say the usual old stuff. I decided I wouldn't do that. But there's two camps. If I break down the argument very, very simplistically and say there's two camps that people tend to fall into. The one camp is that actually this is no different to all the other seismic change that we've encountered over the past 2 or 3 decades. IFAs will take it in their stride. They'll adjust their business model. The payment of advice charges from products will mean that it's a minimal transition. There'll be a little bit of fallout because of the professionalism requirements, but we'll all get back to work pretty quickly. So if that's a sort of characterization of one extreme. And then there's another extreme which says that this is genuinely different. This is a seismic change like none of the others, and it will shake up the industry quite radically. Now, if I was in the first camp, or if I pretended to be in the first camp for the purposes of today, it probably wouldn't be all that interesting a presentation. So I'll take it from the perspective that actually the RDR does have the capacity to change this market very, very radically, and talk through what some of the consequences of that might be. Now, to be perfectly honest, I'd love to have the confidence to be able to say I know exactly what's going to happen. I don't. Nobody else does either. However, it's interesting to think through some of the possible consequences and how different business models are placed in those scenarios. So if I look at different kinds of IFA business model or advisor business model, it's pretty easy to see that actually the extent to which RDR impacts on your business depends a huge amount, obviously, on the type of business you do, the type of clients you have, the type of relationship you have with those clients, and what you specialize in from a product perspective. So if you take the left-hand graph here, you've got business mix at the bottom. If your advisor business or if your sales business is along the lines of general insurance or protection, it's probably not that big a deal. It's obviously a bigger deal if you're a pensions investment advisory house. And depending on whether your relationship is, your business model is relationship-led or transactional in its nature, obviously impacts also on the impact that RDR will have on you. The same way, average assets under management per RI and recurring income streams, I suppose within the IFAs that are in the target market for RDR, this has been the key focus. What's my average FUM per RI? And how much of my business is already on trail. Some interesting stats there. A survey by NMG has said that nearly 60% of RIs have assets under management below £10 million, and 35%, so over a third, below £5 million. And I'm an actuary, but it doesn't actually take an actuary to work out that even at reasonably decent levels of trail, if you've got 75 bips trail, say, on £10 million assets under management, that's 75k gross before you've paid fees, service costs, etc. So going much below £10 million doesn't seem to work from an advisory perspective. And when you think that 35% are below £5 million, pretty soon the model starts to unravel. If you then overlay the client's willingness to pay for advice, and thanks to PwC for allowing me to use this slide, but this is from a study that PwC did, where they basically asked customers how much they would be prepared to pay for advice, and we've all seen this sort of thing in one guise or another, probably over the past 30 years. But what it tells us every time is that the expectation of the cost of advice amongst consumers is very, very different from the expectation of the cost of advice from the industry's perspective. Even amongst the high net worth customers here, which were defined in this example as earning over £100,000, or if not earning over £100,000, having £500,000 of investable assets. The decision context was in, though, an investment of £25,000 for those people, and they replied, or the range that they gave was between 0.6 and 1.6% of the investment amount as being the bounds within which they would pay for advice. And as you can see there, the average came out at about 1%, £250. And actually that range was remarkably consistent. So it was around 0.5% to 1.5% at each of the income groups, which does show you I suppose it's an interesting input in that it's where the consumers are starting when they think about the cost that they might have to pay for advice. Now, the market has already responded. Obviously, we don't wait until the end of the year before responding to what's coming. So there has been a vast movement away from transactional distribution, whether that's been the closure of more transactional sales forces or the advent of platforms and wraps driving a more relationship-led, I suppose, conversation between advisor and client. But there has been this movement away from transactional into relationship. Along with that, there's been a movement from initial commissions to recurring and ongoing remuneration. Again, I suppose it's interesting. This is sometimes described as a move towards fees. It's not a move towards fees. It's a move towards commissions, trail commissions. Commission offset is not the same as fee, but we are in a commission offset world now. We're probably moving more towards a fee world. Increased focus on protection and GI income streams. I suppose the most obvious example of this has been the reaction of bancassurers, who have moved away pretty dramatically from investment in pensions products. Bancassurers were never really big in pension products. Pension products never made enough money to interest bancassurers, but they are moving pretty quickly away from investment products now and focusing on the sale of protection products. And again, that for a transactional business like a bancassurer may be a sensible strategy post-RDR. And then the panel talked about it just a few moments ago. Within the IFA market, the segmentation and increased focus on the high net worth customer base. So focus obviously on the customers that are prepared to pay for the sophisticated advice that IFAs can continue to deliver. So my marketing colleagues got a bit carried away and gave me some graphics. But if I start with the margin for distribution in the middle, the rise of restricted advice could potentially be because of these two pressures from the side: downward pressure on remuneration from the transition to advisor charges. So this talk about where consumers are coming from, and that having a pressure ultimately on what's paid for advice, and increased cost pressures as a result of the new definition of independence, again, harking back to the conversation that the panel just had. It makes sense in those scenarios, and if you believe that margins will be squeezed in distribution, it makes sense to seek more operationally efficient models. And for me, I suppose the most obvious way to do that is to participate more widely in the value chain as a distributor. So as your margins get squeezed, you basically grab somebody else's margin. It's a tried and tested technique, and it's worked in the past, and there's no reason to believe it can't work for distributors in the future. Now, whether the margin that's eaten into is the investment manager's margin or the platform provider's margin, or the manufacturer, platform provider, or manufacturer in this sense are both the same thing. Whether it's their margin or further up the food chain in terms of the investment manager remains to be seen. But if I take this, I suppose, slightly mischievous trend and extend it a little bit longer, it's possible to see the industry going through actually quite a number of transition phases. So we have the first phase where advisors seek more operationally efficient models, what we've just talked about, seeking to participate in the wider value chain through DIFs, distributor influence funds, and platform services. There is no reason why a platform would need to be provided by a life company. In fact, it's quite odd when you think about it that a platform would be provided by a life company. I think it's much more sensible that a platform is provided by a network of IFAs. And in that scenario, that's a pretty obvious way in which distributors might choose to take some of the value from other parts of the value chain. In phase 2 then, you get consolidation. And I suppose some of this is influenced by what we've seen happen overseas. Master distributors consolidating this new ability to control business placement through the wider use of own manufactured products. So in other words, once a master distributor has formed a platform and has their distributor influence funds on that platform, and once the RI who's advising the customer has got over the idea that he's not independent anymore and is in a restricted mindset, then it is possible to exert a huge amount of control from the center of that organization and to generate value in doing so. Now, the reaction from traditional providers in other markets, and a potential reaction in this market, would be to try and control distribution in another way. Now, the way that's worked in other markets actually has been that providers have tried that, failed, and then bought the master distributors. And then, from, again, I suppose, just a hypothesis, maybe from 6 years hence, we get to end state where both traditional manufacturers and traditional distributors have become vertically integrated firms. So now we don't have this distinction between distributor and manufacturer that we had in the past, but effectively they're all vertically integrated firms competing with one another, building and selling their own products. And in that scenario, independent distribution still exists, but it's a much smaller part of the market than it is now by client numbers. It might still be actually a very substantial part of the market by assets, but a small part of the market by client numbers, focusing totally on the high net worth sector. Hopefully, I have succeeded in my aim to be sufficiently controversial to prompt some questions, but that was all the slides I had, and hopefully now we have a few minutes to take some questions or comments.
Yes, any questions for Barry? Let me ask, just to kind of get you thinking, I'll ask one question, Barry. I kind of note your comment about rising restricted and taking some a bigger share of the value chain. Is that kind of what's behind the reinvention of the or shall I say the partner from the Pru?
No, it wasn't. I mean, again, I wish that that my plans were that well thought out. Actually, the Prudential financial planning arose from something entirely different. Well, I suppose maybe it's linked in that we have about 7 million retail customers in the UK, and the vast majority of whom came to us from the man from the Pru many years ago. They're very modest fund sizes, and they have no access to advice. So it was in exploring what we could do for these people that we discovered that there was a latent demand for an advice service direct from Pru. It's not a threat, I don't think, to IFA distribution, and it made sense. We felt we could build an economic model that could service these people effectively independent of our IFA-focused business. So we don't, no IFA clients are targeted by PFB. It's all just the direct sales force stuff. But I suppose, I mean, I can see where the question came from, because I think actually in the future it's probably much more, PFB is a relatively small business. I think though some organizations, possibly not the Peru, but other organizations will attempt to build very large vertically integrated firms. So in other words, right from manufacturer to distribution. In the same way, I mean, that's essentially what St. James's Place is. I mean, there is one obvious example in St. James's Place already, but whether other organizations choose to build something like SJP, I think there's probably a good chance that they will.
So a strong view there that there's a big opportunity for face-to-face advice, which might be in slight contrast with some of the earlier comments. Any thoughts from the audience? Any questions from the audience for Barry? Not at all. Okay. Well, just a gentleman here in the front. Yep. Perhaps a microphone just to the chap with the jacket. Yeah.
Yeah, you've kind of gone through here. Sorry, I'm Rahul from Professional Advisor magazine. You've gone through, how you think things will go over the next few years. Do you think this is how the FSA foresaw things going? And if they had known this would be the eventual consequence, would they have still gone about RDR the same way, do you think?
I'm not sure that the FSA would want to be trying to predict the way the market is going. I think the FSA's view was, we're taking these decisions to improve outcomes for customers, and the market will react around those changes. And actually, that's all that a regulator can do. You can't. I mean, I don't think any of us would want the regulator trying to pull strings at such a high level that to try and micromanage the market. The whole thrust of RDR from a regulatory perspective was to improve outcomes for customers. What happens then in terms of the commercial reaction is, I suspect, fine by the FSA as long as the improved outcomes for customers are delivered. And I don't think any of this is a threat to any of the fundamental aims of RDR.
Thank you. Any more?
From Legal in General. Is that working? Oh. Talking about vertically integrated firms, following on a little bit from the previous question, the regulator has already brought out some regulation to basically dampen vertically integrated firms. Do you think that will continue?
I think the guidance that the regulator has come out with has been around protecting consumers in areas like distributor influence funds. And there is, I mean, to be honest with you, I think that's absolutely right. I think it's very, very important that we don't go back, or we don't lapse back into people believing that these are like broker funds from the 70s and 80s, etc. We all have an interest in these funds being run professionally and consumers getting good outcomes from them. However, I mean, I think there's a certain logic to the advent of vertically integrated firms that I think seems unassailable to me, in that you have to assume that advisors and advisor companies won't act in their own best interests in order to conclude that vertically integrated firms won't become more common. It's back to the fact that if you're an advisor and you have a squeeze on your income as a result of having to be totally transparent with your client about the cost of advice, then the natural first place to start is to try and replace that income by looking at other members of the value chain and saying, well, do I need to pay 75 bips for asset management? Can I buy a better fund at 40 bips, and that 35 bips then either gets returned to the customer or replaces some of my lost income? So that's why I think the squeeze on distributors will result in a squeeze on everybody in the value chain, and we'll end up with a lot of distributor firms, as well as a lot of manufacturers, figuring out that vertical integration makes a lot of sense.
Gentleman there on the right. Yeah.
Earlier, sorry, Kerry Chapman from TCS. Earlier we heard about service being a key differentiator for advisors in the new post-RDR world. How's the Prudential looking at differentiating their service?
Well, okay, I mean, I missed the context for that remark, but I suppose my starting point is we're too focused as an industry very often on the top 5% of the population. I mean, actually, you can understand why this happens because that's the vast bulk of the assets under management, etc. But actually, when you think, we've got to think about, I think, service in the wider context of the service to Mr. and Mrs. Britain, if you like. I'm not that worried about I think the service provided by IFAs at the top end of our market is already exceptionally strong in many, many cases. And some of the technology platforms that IFAs have access to now are superb. I mean, they are genuinely very, very useful. I mean, I take issue with the fact that they're nothing to do with the consumer. They're, you know, when we talk about the benefits of platform to the consumer, what you hear is an IFA being described, you know, an aggregated view of all my holdings. That's what my IFA gives me. Actually, what the platform gives the IFA is the ability to present that to the consumer in an efficient way. So obviously, from a Prudential perspective, our focus is on continually making ourselves easy for an advisor to deal with. Now, what that means for us, because we haven't built a platform, what that means for us is having as many electronic links to as many platforms as we possibly can. So what we want to do is accept that an advisor, it'll make sense to an advisor to install some sort of back office system or some sort of platform in his business to make his life easier. Therefore, we have got to make it as easy as possible to link to all of the platforms that an IFA might choose. Because I suppose the way that I look at it is that the platform industry is trying to solve a 1990s problem. It's almost like, you know, when I was going to bore you with a story about iPads from my kids, but it's almost as if the technology has moved on. So actually, the idea that an advisor is sitting in an office surrounded by filing cabinets and there's paper piling out, I mean, it doesn't happen. It doesn't happen anymore. It used to happen. And the reality is that actually, because all of the providers have built reasonably decent electronic links, actually, a virtual platform is all that's needed. So in other words, a back office system that links. As long as the links are seamless, it doesn't matter. Why would you build an extra piece of kit to sit in the middle? So I think our focus in Pru has been, let's have this open architecture, for want of a better word. That means that we make it easy for an advisor to deal with us. But we don't impose our solution, our platform solution on any advisor. Let him choose his platform. And to be perfectly honest, my view is he'll probably build his own one when the technology becomes cheap enough.
Thank you, Barry. That's all we've got time for in this session now. Then, can I ask you then to thank Barry in the usual way? Thank you.